We are at that point. Obviously, things are changing. Obviously, this political social revolution, which is of the magnitude of democracy itself 250 years ago, is happening with Brexit and Trump and things like that. And this is just the beginning. This is going to end much differently than it started, and it's going to change things more than any time in history. The entire bull market, the greatest bull market and boom in history, started after the American Revolution, when democracy, industrial revolution, and free market capitalism. Adam Smith, he's the best economist in history. He published his book in 1776, the year they signed the Declaration of Independence and the year they perfected the steam engine, which was the first big driver. So we're in those type of times. And we have all this, you have the Federal Reserve, the central banks have gone nuts. Printed $16 trillion. The bathtub keeps leaking and they just pour more crap in. You can't live off of free money. Last time I checked, you don't get something for nothing in life. Although people now have come to believe that. Trump keeps doing what? Surprising everyone. Now he saw something my father taught me. He said, son, people think the biggest mistake people make in politics, they think it's the average person that decides elections. They think it's Homer Simpson. He says it's not. And my father was a big fan of all-star wrestling. It was his comic relief. He says it's the all-star wrestling fans. He said 15 to 20% of the people decide elections. Now, many, many years later, in my demographic research, I do come across the fact 16% of people regularly watch all-star wrestling. Right as he said. And it's not that they watch all-star wrestling that's the problem. It's that they believe that it's real. Okay? That's the problem. Donald Trump saw, better than anybody, there was a huge, and it's way bigger now, 30-some% of people in this country are very dissatisfied. They have all the energy, all the anger. He saw that and played on that and surprised everybody by winning. And he's still doing that. Now, I'll just tell you, revolutions are not, they may be started by the disgruntled, but they're not ended. Something is going to come out of this in the coming decade that is going to surprise everybody. And I think it's a principle I first brought out in the Roaring 2000s book called the network organization. Anybody watch stock exchanges? I watch them every day. These things are not, where's the management of the New York Stock Exchange? Where's the bureaucracy? Somebody rings the bell, 9:30 in the morning, and runs and gets the hell out of the way. And what happens? All types of chaos. This system is driven totally by users, runs at the speed of light. Everybody knows the profitability of every trade every second, and then they close down things at the end of the day. That's a network. Runs from the bottoms up at the speed of light. Real-time decision-making on the front lines. Our companies have been run by bureaucracies, top-down management forever. This is what's going to change. This is the big productivity. Technologies allow a lot of things, but ultimately they allow to change, as Rodney was saying earlier, how and where we work and live. The significance of electricity and automobile was that it allowed people to move to suburbs much safer, much more affordable. Couldn't have happened without phones, automobiles, TV, all of these sort of things. They all came together. But what really happened, which nobody noticed, Henry Ford. You know who made the middle class? If I had to put it down to one person, Henry Ford. One miserable son of a bitch, by the way. The assembly line took people with low skills and made them highly productive. Focus on one task. Bring the production to the worker. Changed everything. And then Alfred Sloan came about a decade and a half later and formed the first modern corporation, the decentralized decision-making. That was the real revolution. That emerged in the Great Depression largely and made the wonderful boom of the 50s and 60s. Happy days. That's how change actually happens. The only other thing I'll say today, I'm always glad to see women in the audience. The more women, the better for me, and not for the obvious reasons, okay? Women tend to get what I say a little quicker than the men. And for a simple reason. Men think they already understand things like economics and politics. Life has taught men, if you don't look like you know what you're doing, you don't get laid, okay? It's that simple. So this is why men, no matter how lost they get, will what? Never ask for directions, right? And this is why it takes about 1 billion sperms to hit 1 egg. Why do I say that? This is disruption. Disruptors are rare. All types of people improve things. I call that incremental innovation. That's 90-some% of it. It's the radical innovation. The things that create something totally new, like the assembly line or an automobile. Henry Ford used to say, if I'd have asked customers what they wanted, they'd have said they want a faster horse. He said, I gave them a 24/7 machine fueled by gasoline that doesn't shit. You know? How about that? Steve Jobs always said, I'm going to give people what they would want if they only knew it was possible. He didn't do any marketing research either. That's how radical innovators. They change the games. Radical innovators aren't usually liked. Ask Galileo. He walks out, in the 1500s and says, hey, guess what, people? You know, things don't revolve around us. We revolve around the sun. Like, isn't that great? No. Basically, they said, recant or choose the stake you want to be burned at. That's what happens to disruptors. I became a disruptor. I did not intend to become a disruptor. Disruptors, like I say, are rejected, are not usually valued at first. It takes a long time to prove it. But I was just naturally inclined. I started out, I had no idea what I wanted to do in life until sophomore in college, got married, and met my father-in-law. Now, my father was in politics. He was an inspiring character, but he was in politics, and I hated politics. I went to the 1972 Republican convention and couldn't stop barfing. I've never met so many crazy, delusional people in one spot. So I decided, no, I'm not going into politics. My father-in-law was a private investor working from his home. He gets all these newsletters, and back then it was the gold bugs, Harry Schultz and Harry Brown and stuff, and he was into cycles, and then I had this professor at the University of South Carolina who was into cycles. He's 96 today. I still talk to him every month or so. And I got inspired to be a cycle guy. Another bad choice. People don't like cycles. Cycles hard to sell. What people want is to get better. Go to heaven, stay there. Cycles imply you don't get the good without the bad. You don't get the boom without the bust. You don't get inflation without deflation. You don't get dark without light, and all this other stuff. And I used to run around to people and say, look, just get reality. And my favorite phrase was, for every decent person, an asshole is born. And that doesn't sound like good news. But I would tell people, think of it this way. How else would decent people know that they're decent? So God bless assholes, okay? You know, my research shows all the great innovations happen in the downturns and challenging times. All the great entrepreneurs thrive on challenge. Not when things are good. When things are good, all those great innovations move into the mainstream predictably on what? An S-curve. So my view early on is unpopular, as it was, that our economy is far more predictable than people have been led to be. And in essence, it's simpler. Everything's simple and everything's complicated. If you focus on the simple, economists don't say that. Economists tell you nobody can predict the future. It's so complex and and all these factors and stuff. Tells me they don't understand the economy. So I didn't aspire to be an economist. I mean, come on. No chance of ever getting laid, okay? Why would I want to be an economist? Sorry, Lacey. But I saw an opening. I saw that things are predictable. My best subjects were science. Scientists are incredible predictors. Unbelievable stuff they can predict. So far in advance, it boggles the mind. Anybody read Malcolm Gladwell's book, Outliers? 10,000 hours of immersion it takes to master something. I calculate that's exactly about what I got in the 80s, working half-time in business, half-time research, and I just researched everything. And I got my first breakthrough in 1988. My first book was not The Great Boom Ahead, which most people are aware of. It was Our Power to Predict, a little self-published book. 5,000 copies. You want one now, it's going to cost you $120 because there weren't that many of them. In this book, we had all the templates, spending wave, inflation indicator, 4-season economic cycle, all this sort of stuff right from the beginning, because the breakthroughs started coming right at about that 10,000 hour point. So here was my first breakthrough indicator, the spending wave, or what I call sex drives the economy. No surprise economists missed this one, huh? Sex plus how many months? 9 months? Plus how many years till they're spending the most money, have the peak impact on the economy? 46. Is that simple? Lag forward the birth index, 46 years for the quantifiable, back then for baby boomers, peak in spending of the average household. Boom, bust. Until what happened? What happened here in this yellow part? Central banks went nuts. They ruined my perfect chart that worked so well. Because it started to go down. People don't like down cycles. Economists think they're supposed to turn the economy into a machine, grow 3%, 4%, 2% inflation, and never have a recession. That is what their goal is to do. You know what that says to me? They don't freaking understand our economy. It is the play of opposites. Inflation, deflation, boom, bust, and on and on and on. They create the dynamics of innovation and disruptors. Not a steady state coma economy like the Japanese have today. Now, they've bought into quantitative easing forever. So boom, bust, boom, bust. Now, we have to take the birth index and we have to adjust for immigration. And we just made a big adjustment to immigration because a new report came out and said, you know what? We don't have 11 million illegal immigrants. We have more like 22 million. And the reason is simple. The previous estimates were based on surveys. How do you survey people that are hiding? And even if they do answer it, are they going to say, yeah, I'm an illegal immigrant, deport me now? You know, how do they know, somebody's not going to get this information? So these guys came up with a sophisticated approach, said, no, there's more like 22, 23 million. So again, we calculate this, and now, for the first time since the early 1990s, you got to realize, we had a big immigration surge before. I hate to say it made America great, by the way. The whole roaring 20s boom in the 40s, 50s, a lot of immigrants driving that. Highly motivated people. It's another principle I'll get into later. Motivation. How do you find it? What is it? 14.7% foreign-born around 1910 at the peak of that immigration wave. And in the roaring 20s, we started restricting immigration, and then the Depression just cut it down to 0. That's happening now. That is not a good thing demographically. Whether you like immigrants or not, I can tell you demographically, losing immigrants or having them go back home is a bad thing for the economy. But now we have 16.4%, the highest ever. And this is when you would expect what? Like last time, a backlash against immigration. So that's a real trend. This has happened enough that people saying, okay, good for a while, enough is enough. Just like they said, globalization and trade was good, but now we're losing too many jobs to Asians and overseas. This is the time when we get a backlash and we get a revolution because people aren't seeing the benefits, even though they may be there. And when we did redo this chart for that, what it did, if you notice over here, the next boom comes from 2023 to 2036 or 7 for the millennials. And it used to be there was a second wave that would take us back to those heights, but this new wave of immigration hits more the early wave and not the later. So the best of the next boom in the United States is going to come from 2023, 2036 to 37. And we, unlike economists, what economists do, straight line extrapolations. We're going to take the best years and just project that in the future like we never have downturns, never have resets, never have recessions or depressions. That's what they do. And if they say, oh, we can't afford our entitlements and stuff, well, if we put it up to 4.5% growth and do this and assume that, yeah, it kind of works out somewhere down 20, 30, 40 years. We don't do that. We build cyclicality, which we can predict, into our own models. I predicted a decade or more before it happened that 2007 would be the peak in births and they would decline from then. Because people don't have as many babies when the economy sucks. Is that hard to understand? And immigration does what? I hate to say it, folks, we're trying to build a wall and they're going home. They're not coming anymore. More illegals in the last 10 years have gone home than come in. We already had the big wave. We're going to have to build a wall in Canada to keep people from leaving at some point. But again, all this stuff, we get new information on immigration. The birth index has been going as we thought, but if it goes lower or higher, we can adjust that and know for your kids and grandkids what the economy is going to look like years and decades from now. And guess what? It doesn't look good. Now, I'm going to show you later why I don't think this demographic black hole, I call it, is going to happen as almost all forecasts would suggest. Because there's technologies and there's disruption. Now, I can predict all types of stuff down to tiny categories. I know when the average male in the U.S. has a midlife crisis. I just pull up the motorcycle chart. 45 to 49. How's Harley Davidson doing lately? Not good. We predicted that decades ago. We know when people will spend the most money on potato chips. Born 28 as kids, calorie intake peaks at 14, 42. That's what the numbers come out and the actual statistics for the peak in potato chip buy. So if we can predict potato chips decades in advance in any county in the country, what the hell is not predictable? We have been told by economists that nobody can predict things, and that's why we need them, so they can always explain after something happens why it happens, and they can get to call it a black frickin' swan. There are no black swans in my book. Bubbles are the most obvious things, and people say when they burst, oh, it's a black swan. You didn't see that 30-foot wave coming on the shore? Was that not obvious? Apartments, 26. This is for baby boomers. It's going to be a little later for the next generation. Get married at 26, peak of apartments. Kids born 28. Starter homes as soon as you can afford them, 31. You know what? I would have thought people would buy their biggest, best, nicest home at 46 at their peak of spending, but they don't. They buy it at 41. How old are the kids at 41 if they're born at 28? 13. They're frickin' testy teenagers. You want them down the road from, no, you want them on this side of the house and you want to be on this side of the house. My sister had a glorious house in Spartanburg, South Carolina, just would not sell, because the kids' bedrooms were on the same level as the master bedroom. Nobody wanted those stinky little teenagers right down the hall. Travel's my favorite. Obviously, people start to travel more when their kids leave the nest in their late 40s, early 50s, depending on how affluent they are. And they travel, and what do they find out? Travel's a little stressful. Montezuma's revenge, jet lag, waylaid in customs, missed flights. I've had to sleep in airports like Heathrow a number of times. Just sleep on the damn benches, and they put these poles on there so you can't relax and lay down. Bureaucrats just making people's lives harder, okay? That's what they do for a living. So what they do, about age 60, they say, too hard. But put me on a cruise ship, stuff me with booze and food, I'm happy. No changing of rooms, no customs, no repacking. Cruise ships boom all the way out to age 70. And they're in a big boom right now. And they're building ships so large, they should be outlawed. But the larger the ships, the more popular. Why? More to do. Nursing homes are the last thing to peak. That should be obvious. Who's in these nursing homes at age 84? Women. 10-to-1 women. So the secret for you men, if you can just make it to 84, you can have more sex than you ever had in your life. I didn't say good sex, but you know. So it's not just the economy booming and busting with generational spending, different segments. Even in downturns, there are segments booming. In upturns, there are segments waning earlier. Housing always peaks ahead of autos, and did this time. The next breakthrough, now 1988 was a spending wave. 1 year later, I'm looking at this chart, workforce growth over many decades, and I'm looking at this chart, inflation. And that, like the birth thing and the S&P 500, these two charts look exactly alike. I'm like, what the hell would workforce growth have to do with inflation? Took me a while, but I figured it out. Young people. See if you agree with this. Young people cost everything and produce nothing. That's inflation. That's the biggest single cause of inflation. And this simple indicator, workforce growth on a 2.5-year lag for when they finally get in the workforce and learn enough to be productive, is what drives inflation. If you got a better correlation with that, even short term, I will kiss your ass in public. You're not going to find it. Do oil prices correlate? Does Federal Reserve? Quantitative easing. How much quantitative easing have we had? $16 trillion. We don't have inflation. Anybody thinks it's a monetary phenomenon, like economists, and Milton Friedman famously said, inflation is entirely a monetary phenomenon. I don't believe anything that doesn't spring from people. That's my view. I look at people, not bullshit government manipulation policies and stuff. No inflation with the greatest creation of money in history. And we're going to have a deflation ahead. And we've been saying for years now, there's going to be a bond trade of the decade, and it's probably within a year of us. I'll show later how that's broken out. You're going to be able to lock in, like people could have in the early 30s, lock in bonds at their highest rates and watch deflation take those rates down. You lock in higher rates than dividends on stocks, and you get capital appreciation when stocks and real estate and everything's falling from the deleveraging of debt. Which economists don't understand. Why do we have Lacey here every year? He understands everything from monetary velocity to debt bubbles, financial asset bubbles. Economists just put on their blinders on, oh, it's just a black swan or da-da-da-da-da. No, these things have a cause and effect. And put together predictable generation cycles of spending, the blue line, and predictable cycles of inflation. The baby boomers caused inflation as they were entering the workforce, unproductive in massive numbers. And then inflation magically went away. Federal Reserve policy didn't do that. I could have predicted that with no indicators from the Federal Reserve. Volcker just walked in at the end, was extreme, did the opposite, tightened policies, and then inflation seemed to disappear. Would have disappeared without him. We don't need the Federal Reserve to set interest rates. Markets do it every second of the day and aren't into manipulating the economy and preventing the very cycles that make us rich. We had an economy that did not have a recession for 30 years, we would have a bad economy, I can guarantee you that. Recessions create innovation. Now, but another thing, very important, and again, understanding the dynamics, looking under the hood. Most economists feel like inflation is what? Kind of a bad thing, right? And it can be. You have a shortage of oil or OPEC, yeah, that's bad for the economy. You have to fight a war, and you have to spend all this money that doesn't produce stuff, and consumer goods get crowded out. That's bad for the economy. What I found through this 500-year cycle, and people say, Harry, why do you look at 500-year cycles? Who cares? I care because it gives you perspective and it gives you direction. This cycle right here is the very cycle that I do not believe we're going to see this demographic black hole where one country after the next, and it's already happening, starting with Japan, peaks and slows and actually contracts. Even the emerging countries, and China's already started. I don't believe that's going to happen forever because this cycle says we're only halfway through. And inflation is the best long-term indicator for progress. About a 30-year lag. When do they cause inflation? When they're young, 20-ish. When do they spend the most money? 40-something. 25, 30-year lag. Inflation, more important, reflects the most critical principle of economics, which I also don't think most economists get, the specialization of labor. When people can focus on what they do best and delegate other tasks, and countries do this too. That was Adam Smith's first premise. Free market capitalism, the specialization of labor, specialization of nature. Well, also workers. People who move into urban areas have more job choices and can specialize more. The difference in GDP per capita from an uneducated person in India, Brazil, or China, where I can measure it, in a rural area and in an urban area with no change in education is 3 times. Inflation is caused by the fact that we have to pay more to other people to do what we used to do when we were living Little House on the Prairie. Anybody want to go back to Little House on the Prairie? People tell me the good old days were better. I just slap their ass. It's crazy. The past was way more brutal, way more difficult. People were way poor. We've had more progress in the last century and a half than all of history put together. We're halfway up this cycle. This tells me we're going to see breakthroughs in technologies. What is the logical breakthrough to kill this demographic hole? Are we going to start having 4 or 5 babies? No. Countries are giving away all types of incentives. People won't have more kids because they're a pain in the ass. I'm sorry, but, they're difficult. They're expensive. You'd rather have 2 and educate them better. That's the ethos. That's not going to change in most places. What if we live longer? We already went from 40 to 80. What if we went in the next 45-year cycle in technologies, which I'll look at? What if we went to 100? And then what if we went to 120? I think this is highly likely. That means you're no longer having people dying offsetting the fewer people born, and people stay in the workforce 60 to 70% to up to 100% longer, produce twice as much in their life, learn more, earn more, return more. This great explosion in the last century had a lot to do with rising life expectancies. And here's the proof. When did this 500-year cycle click in? 1896 was the bottom of deflation, so that's my estimate. And since then, real wages in the United States have gone up almost 8 times, adjusted for inflation. Now, gold bugs, God bless their souls, because at least they understand debt doesn't work and you don't get something for nothing. But they'll throw this chart out that says, the value of a dollar gone from $1 to 3 cents. We've debased our currency, which implies we should be a lot poorer. Doesn't look like it to me. Now, and over time, and you got to remember, our research evolves. Started off with the spending wave and demographics. I tell you, for a decade and a half, that was enough to nail the whole thing. But then, something happened after the tech wreck. Stocks didn't come back as fast, even though earnings were strong, even though demographics were strong. So I've had to keep adding cycles. And I learned from the best scientists who are good predictors, the only good predictors I found in the world, other than life insurance actuaries. They're accurate. They will tell you when the average person is going to die, down to the decimal point, and based on how old you are now. The older you are, the older you get. All types of these guys know how to predict. That's the only course I took in college where I said, here's some people who know how to predict stuff, except for scientists. Most scientific cycles will have 3 they'll boil it down to 3 key cycles for climate. It's a 100,000-year cycle, a 42, and a 21,000. Those 3 cycles will predict climate as far out as you would ever even want to dream, and it's why we get ice ages about every 100,000 years. The only difference it's not exactly 100 is those other 2 cycles, the shorter ones may skew it. They can predict this stuff hundreds of thousands of years in advance. It's crazy. So I got 3 cycles now. I started with demographics on the top. Those peak about every 39 to 40 years. Back in biblical times, it was quoted generation cycles is 40 years. And people say to me all the time, Harry, but if people have kids at 28, well, that's the next generation. No, generation cycles don't work that way. Your kids are not necessarily the epitome of the next generation. Generations come along about every 40 years, even back to biblical times. Then I added the geopolitical cycle. Again, I got crucified for predicting Dow 32, 35,000. That would have been the logical sequence if the second bubble had been as strong as the first. It wasn't. It was half as strong. So I had to ask myself, what changed? How about 9/11? Did that change things a little bit? Geopolitical cycles peak and decline about every 34, 35 years. And then finally, the latest cycle, and I had this from my co-author in Zero Hour, Andy Pancholi. 2 of his important cycles, just from cycle work, was 45 and 90. Well, I didn't have a good reason for that. Well, I kept digging and kept digging. I did find, steamships, railroads, automobiles. Every 45 years, an old set of technologies peaks and then starts to decline rapidly as the new come in and replace them. And then finally, and I get the most shit for this one, sunspot cycles. Now, where did I hear about sunspot cycles? I heard about it a long time ago. They said they were 11 years. I don't have anything that correlates with 11 years. 10 years, yeah. A lot of other numbers, not. So I didn't pay much attention. Then the top fund manager at the time at PIMCO said years ago, he said, you know what saved me from the 2000-2002 crash? Sunspot cycles. I said, you know what, maybe I need to relook at this a little. I go back in the time frame that Ned Davis's decennial cycle, which we were already using, it was 10 years, not 11. And then I go back in history, the 1850s, and find that 88% of the recessions occurred in down sunspot cycles. What a sunspot cycle is, 20% more radiation up here, 20% less down here, and more rainfall. So that's good for crops. But don't you think people feel a little better when they're getting more juice? So what do I use sunspot cycles? They're not one of the major, I have these 3 long-term cycles that all turn down together at times, like presently, like 1930 to 34, and like in the early to mid-70s. When these things all turn down, you can pretty much expect the economy to be difficult. Now, if I look at these broadly, and here's how I use it now, of the big cycles, there's 3. If I look for when all 3 cycles are up together, I get certain dates. But you know what? For investing, to capture the whole thing, I capture more the entire boom and bust if I use 2 cycles. If 2 out of 3 are cooking, and then what you do is when it comes in the middle, you're going to get all 3 on, then you could take more risk or double down a little more. Just tilt your portfolio. This allows us to see major cycles in the future. I will stand on this today, and then quantitative easing may delay this a bit, but around 2023 to 2036 or 7, we'll see the next global boom. But, unlike the past one we've witnessed, it will not be uniform. There'll be countries in Europe and East Asia still having rapidly declining demographics. There'll be stronger countries like Australia in the developed world. And of course, Asia and the emerging world will take most of the growth. So you're going to have to focus different investments. From 83 to 2007, when these cycles were positive, everything did well. What did not do well? Commodities, real estate, stocks, everything went up, and all around the world. That will not be the case next time. I can tell, and Andy agrees with this, we're whole different things. He has the same, basically, time frame. The next Great Depression will be somewhere between 2069 and 2079, and my cycles say more 2069 to 74. Just in case if you want to look good to your grandkids long after you're dead, just tell them that today, write it down, tell them to look it up. I don't care, I won't be here. Now, but my greatest innovation, of course, financial bubbles are orgasms. Surprised economists didn't pick up on that one? They're not like orgasms, they are orgasms. I forgot, back in the 90s, I was running around talking to small business CEOs and stuff, and I'd throw up, just for a joke, I'd say, look, bubbles are orgasms. This is scientific orgasm, okay? This is Masters and Johnson's scientific study in the late 50s that charted the progression of an orgasm, and guess what? This is the male orgasm, by the way. Women have it a little better. Once it peaks, what happens? Men are dead. We're done, okay? Takes so much energy, you get that thing, bam! Woman wants to talk. Maybe smoke a cigarette or something, have a drink, you know? Nope, not the men. Boom, we're done. Bubbles burst twice as fast as they build. So again, I say there's no black swans, including bubbles. So in The Sale of a Lifetime, in the 0 Hour book, I developed a bubble model for stocks, real estate, and commodities. Here's an example on the NASDAQ. I have to first determine when did trends start to go from the fundamental trend. When do we go from straight line to, oops, people are just buying because they're buying. That's the bubble start. We go up exponential. How long does it take to get to the top? In the case of the NASDAQ, it was about 5 years. That tells me the bottom's going to come 2.5 years later, give or take. So this bubble model would have forecast an 84% crash in the NASDAQ, 1 month bottoming 1 month before it did, but it was down 78% in 1 month off. That's pretty damn good for a black swan. Bubbles are totally predictable. They build in a predictable way, exponentially, and they crash in a predictable way. I'll show you, there's a few exceptions. Bitcoin and gold are two of them. And that tells you something special. Now, part 2. The economics of disruption. You look at history, there's one clear thing. Demographics comes and goes, and yes, it's a factor, but you know what? Before Henry Ford invented the assembly line, and we had the first middle-class generation, the Bob Hope generation, which only started to impact the economy after World War II. We didn't have a middle class to drive. The middle class made the spending wave suddenly way more powerful. Of course, growing demographics is good, but it wasn't the biggest factor back in history. New technologies. New technologies come slow at first, testing in niche markets. If they make it and get accepted, they rush into the mainstream on an S-curve, and then they mature slowly. S-curves are totally predictable. Who creates S-curves? Disruptors, entrepreneurs. I mean entrepreneurs with a big E. Not somebody who opens a local dry cleaner to substitute a job and run their own business. That's fine. That's incremental innovation. Not somebody that takes a radical new product and makes it a little faster. Look at that. Crazy people create new things. Disruptors are crazy people. I know. I am one, and I've worked with dozens and dozens and dozens, close up. Let me tell you what most entrepreneurs have. They're either bipolar, schizophrenic, borderline, ADD, or dyslexic. I count 2 or 3 were all 5. So that's my best bet, okay? These people think differently. They don't fit in. They are highly motivated. Peter Drucker called these people monomaniacs with a mission. These are the people that don't care how much they're rejected. These are the people who go on Shark Tank. Damien, John, was just mentoring some young little Mose Bose boy, maybe 12 years old, budding entrepreneur. He said, I was dyslexic. I couldn't even read when I was your age. These are the people that create innovations. Now, I'll go a step farther, and I learned this from managing a number of businesses, consulting numbers of businesses. When you're hiring people in your business, let's say you got a happy person, bright, happy, and you got a person that's kind of not so happy. Who do you want to hire? The not happy person. Happy people are happy. They don't have any motivation. They're happy already. Unhappy people want to get happy. Unhappy people want to prove themselves. Unhappy people will do anything. My first lesson in the S-curve, Bain & Company. My first case, wet behind the ears. Firestone Tire Company. They had just been surpassed by Bridgestone and Michelin in global market share, and they didn't even consider them competitors because they're making these newfangled radial tires. Who the hell needs a tire to last twice as long? Well, 7 years, radial tires replaced bias in the United States. I had to develop a model to prove this to the company, so I used the S-curve and I used a derivative of demographics, passenger tire miles. Older people up to a point drive more, just like they spend more. 46, by the way, the same point. I developed a model on a napkin that beat a multi-million-dollar model staffed by 8 people at Firestone with a simple model, S-curve plus demographics. S-curves are predictable. Here's the classic one, highly documented, the automobile industry. First commercial cars produced 1900, 0.1%. Only rich people could afford that car. 1907, Model T, standardized production. Oh, that brought the cost down. Now, 1%, 10% the assembly line, off to the races. So it took 14 years to get to 10% of urban households to afford a car, and in 14 more years, 90% had them. Now, still people in the suburbs, which hardly existed, rural people didn't have them. Why could you not have them even had money? There's no roads, there's no service stations, there's no infrastructure. S-curves, as I showed in the first thing, they overlap. When one is hitting its greatest growth, about 90%, you'll see the next one emerge. But it's emerging in niche markets. It's not that powerful. They're only selling to a narrow group of richer people or more sophisticated users. But that's what determines if it's going to be the next S-curve. So here's a classic 4-stage cycle for a business, like cars moving in the roaring 20s. Innovation, early 1900s, first growth boom, into 1919, and a big shakeout. Most people don't realize we had a darn near depression when the auto companies were shaking out in the early 20s. Went from like 100 companies down to 30, and then the race for leadership, the people who dominate get the cash cows and run it into maturity. Spring, summer, fall, winter, innovation, growth boom, shakeout. The shakeout comes right in the middle of the S-curve acceleration, exactly when nobody would expect it. But that's what happens. If you don't understand the models of how this happens, businesses will not see this coming, nor investors. And overall history, and this, remember, my latest cycle, about maybe 4 years ago, 45-year innovation cycle, that was the last cycle that completed my kind of hierarchy of cycles. Steam engine factories and steamships peaked. I got this only by, again, tripping on some old charts. Steamships peaked in 1875 and fell off a cliff while railroads emerged. Railroads peaked in 1920 and fell off a cliff. I mean, not dribbled, fell off a cliff while autos and trucks. You know the biggest revolution back there? Tractors. Nobody gets there was a tractor revolution in the roaring 20s. Well, not just automobiles. Tractors changed farming more than any investment. Now you got a tractor that doesn't shit just like your car, okay? And never stops. And doesn't take any human guidance. Automobiles, internet, biotech. Now I'm oversimplifying here. Every time you have a revolution in technologies, every 45 years, and this is very clock-like, it is a cluster of technology. It was automobiles, phones, electrical appliances, TV. Was TV a big thing? People in their living rooms can see the whole world and what's happening. They come together. And that allowed the movement, as I said earlier, to the suburbs. It was a huge boon to consumers. Lower costs for companies. Technologies change the game, and they're always disruptive at first. The key thing as an investor or business is to determine when that 10% point hits and it takes off. You miss that, you miss the game. Even if you catch that, you're going to have to survive that shakeout right in the middle between 40 and 60% on the S curve. So now an update though. On this cycle I've found, in every single one of them, once the old technology's peaked, and that's the easiest thing to determine, for another 6, 7, 8, 9 years, you get a kind of an extended boom, especially in the stock market, because the new technologies are starting to emerge, growing really fast, even though they're small, and people like dizzy on a good economy, high productivity, low interest rates, economy's great at the top of one of these cycles, and they just over-speculate, and you get something like the internet that goes up for no good reason, or Bitcoin recently. So, I have to look at this cycle when I'm looking at the stock market and say, okay, if the railroad cycle peaked in 1920, I'm not expecting a peak in the cycle overall until about 1927 to 29, and same all the way. And we'll show every other cycle is more potent. Now, here's another important chart I've always used because it's just reality. I know it's long-term. I know people don't like to look at long-term stuff. But that's a pretty impressive chart. Let me tell you how impressive it is. This is a logarithmic chart, which simply means takes an exponential trend like an S-curve and turns it into a straight line so humans like us can understand it. We relate to straight lines. We think in straight lines. Another big error. Any good technology expert knows everything is exponential long term. And we add to that, and I have to debate the technology experts, and we add and cyclical. Exponentially up and exponentially down. So everything's exponential and cyclical. Look at this after the American Revolution, democracy meets free market capitalism, where I say Harry met Sally, and everything. Those two things are opposites. Republicans see them as the same thing. Freedom and innovation. No, they're opposites. Democracy makes sure the spoils are spread, and free market capitalism is the driver of innovation and rewards with merit the most innovation. What you end up having in most of history is a tiny group of people control everything and everybody else are peasants. We haven't had that since Henry Ford created the assembly line. We didn't have that as much after democracy. These two things balance each other, and they're both necessary. But this chart shows since that revolution, 250 years ago, which we are going through now, every 90 years we had a major reset. 1837 to 1842, biggest stock crash back then, and more so the biggest real estate bubble crash in all of U.S. history, because the governments wanted people to move to the Midwest from the East Coast. They gave damn near free land. They gave easy, low-cost financing. And when you do that, what do you get? Speculation up the wazoo. Just say today, as best I can, if this cycle hits the most squarely around late next year, late 2019, we should see something like a replay of 29 to 32. If we don't see something happen by the early 2020s, then I've told my friends in Australia, see me there, I'm going to be a limo driver in the Gold Coast. I'm just going to give up. This is perhaps now in retrospect the most powerful cycle of all, even more than demographics, because this cycle was powerful before demographics were made powerful by things like the assembly line. And we have this rare convergence, 250-year revolution cycles, political, 84-year populist revolutions, right on the clock, and 28-year financial service. Andy and I put these two sets of cycles together. We're in the beginnings of something that's going to change the world more than we know, and all you can do is be aware of it, know there's going to be a lot of disruption, and look for the opportunities, because there are going to be enormous ones. So think, if you'd have bought anything at the bottom of these resets, like you could have bought anything in 1932, 33, any piece of real estate not demolished, any stock not out of business, any commodity, and made money for decades and decades and decades. You would have bought at the lowest point, and then And same thing. If you'd have bought anything in the late 1700s, greatest boom in history to follow. Globalization is in its second surge. And we said this years ago, this is not going to be a short-term thing. Jack Ma of Alibaba, you heard of him, right? He's the primo entrepreneur, and he's smart enough to get out of his company and let somebody else manage it. This guy's my hero. Most entrepreneurs don't do that. I went out and found Rodney as soon as I could. I knew entrepreneurs are great at creating shit, but they are disruptors, so they're not good at managing shit, okay? You can't be good at both. It's impossible. Jack Ma says, this is a 20-year plus war. U.S. versus China. Who's going to be the top dog? China's willing to take it in the chin, and we got them over the barrel right now. Because we import 3 to 4 times as much as they import from us. So we got them over the barrel. They're not giving in, because this is a long-term battle, and they're long-term thinkers. There will be another globalization surge that your kids and grandkids will see, and it will take us to the highest point. Real quickly, most people don't understand. Life exploded, economies exploded, especially in the late 1800s. We were in this Malthusian trap, economists call it, where if people had more demographics, had more kids, and you're in the same city or land, you put pressure on limited resources and prices go up and people starve and things die. Demographics was not a positive thing back then, unless you moved to new areas where people could grow. But in a fixed area, no. And, love this chart. Here's the progress of the world. Where is it? Eastern side of the United States, Western Europe, the brightest lights, the most energy, the most affluent. Up and coming, what do you see? The China and India. 50 years from now, between China and the Middle East is going to light up 2 or 3 times over that. This is progress. Look at Africa. Dark. Most of South America, dark, but a lot richer than Africa. Now, real quick. Cycles. I have long-term cycles. I have shorter-term cycles. They all play a role. They all give you perspective. Here's my list of the most important ones. If I want to look at innovation, I will put the 500-year cycle with the 90-year and the 45-year innovation cycles and give me the best, and I'd be able to project out. And again, I'm saying that 500-year cycle says we're nowhere near our top in standard of living, and there's no way we're just going to die out from demographics. It says this clearly. I would not see this without having that bigger cycle, even though I won't live to see it. If I'm looking at inflation, 500-year inflation and innovation cycle, 60-year inflation cycle, 30-year commodity cycle, and of course I showed you my hierarchy before. 45-year innovation cycle, 39, 40-year demographic, and 34-year geopolitical. When they point up together, when they don't, will tell you where things are going well out. And if I'm looking at an emerging country, I throw out the 45-year innovation because they're on the lagging edge, and I throw in the 30-year commodity because most of them are commodity exporters. And if I really want to get a long view, the world's going to be at its best, like it was in the mid-1600s, following the Elizabethan Golden Age, which they call that for a reason. Around 2150, this 500-year cycle will be its peak. This revolution I'm talking about today, like the one in democracy, I call it the network revolution, will be at its peak. And the world, which is more obvious now, but it wasn't obvious when I said this 20, 30 years ago, the East will be dominant, no longer the West. Anybody seen the Rich Asian, Crazy Asian movie? That's the future. Rich Asian bitches are going to take over everything, okay? And by the way, women are rising and men are not so much on the S-curve these days. Just, don't shoot the messenger on that one, okay? So we are not going to see this demographic hole. Now, real quickly, I'll give you some advice. I'm showing a lot of stuff just to make a point. How predictable things are. It doesn't matter the scale. Long-term trends are more predictable because there's less cycles involved. Shorter-term trends get more complex. But you're not supposed to be able to predict things like this. And people are going to think you're crazy if you start talking about this stuff too much, okay? So now let's get down to brass tacks. We are in a new environment. This is the curveball of this time. There's always curveballs. Cycles are predictable. There's always a curveball, and it is quantitative easing. It is central banks thinking that they can drive the economy on pure money creation and nothing else. No innovation, never have a recession again. And of course, that's a horrible error and will not end well, but that's what they think. So there's an article recently came out that says, what is water? Water is the environment fish are in. And there's this little thing that says there's these two young fish swimming along, and they happen to meet an older fish swimming the other way, who nods at them and says, "Morning, boys. How's the water?" Two young fish keep swimming on for a bit, and eventually one looks at the other and says, "What the hell is water?" Fish don't notice water. What do we not notice? Air. How long would we last if air disappeared? Me, a minute and a half. I could never be a lifeguard. Most people, 2 to 3 minutes, should be dead. We take it totally for granted. We're in a new environment where the environment is liquidity. Banks have just created massive amounts of dollars in liquidity, which perverts the entire system and creates debt bubbles, financial asset bubbles. What benefits the most in this environment? Stocks, of course. Stocks usually do the best, but stocks have done way better. The NASDAQ, then the S&P. High-yield bonds do very well because not only do they push interest rates down, which make all long-term bonds go up in value, but the risk factor gets taken out of the junk bonds. Junk bonds act like there's no risk of a recession. That's not a good sign. And then corporate bonds, and then treasury bonds. Down there, the little one, 48%, that's real estate. Now, real estate doesn't bubble up as much as stocks, but you have to realize real estate is typically commonly bought with 20% down, so that 48% could look more like 250% to a lot of investors. Here's my favorite index, because most people don't look at this one. It's called the Smart Money Index. People who buy at the end of the day are the smart money. People who buy in the morning and react are the dumb money. This smart money did buy into the January top. They have not bought this entire rally ever since. This is the sharpest drop, much more so than the tech bubble top. So that's a sign that sooner or later, this thing's going to go. Business optimism at new highs. Consumer confidence almost at new highs from 2000. Investor cash at low levels. And the everyday stocks are not doing as well as the S&P, and the S&P's not doing as well as the FANGs. And we've got this yield squeeze. Again, this is something David Stockman's going to talk about. I think this is temporary, like it was in the early 30s. But I think this pattern says we could see 4.3% on a 30-year Treasury bond. That's enough to hurt real estate more seriously and stock valuations. That's the trigger, along with the third world starting to fail. So what are we down to? 2 scenarios. Once Trump got elected, we said, look, you can't bet against this. You can't bet against tax cuts. And he's got another one now, he says, is coming. We have broken out of this channel, which is the first danger sign. We could have seen a top here recently. I still tend to favor we get one more rally, and it takes the Dow to as high as 30,000 and the S&P as high as 3,300 or so, and then we crash. But between now and then, and we're going to be monitoring this much more, the more this market breaks down, the more likely scenario 1 is, and if it can hold a little below here, the more likely scenario 2. But either one of them terminates by late next year. Gold. I used to say gold was going to go down to 700 minimum, maybe 400 to 450. That's on my bubble model. There's a reason I said that. Gold is not following the bubble model. It is basing, and it may go down to 700 at a minimum, but it may just base for the next so many years and then make a long-term run to 4,000. What's that? That's the next 30-year commodity cycle. So I'm not saying, like the gold bugs, the gold's going to suddenly go to 5,000. We have this crisis, and everybody's going to say gold's the new money. Gold is not the new money. Gold is an inflationary hedge, not a deflationary hedge. So just be clear on that. Bitcoin. We got Michael Turpin speaking tomorrow. Met him in Puerto Rico. He's the primo expert on this. When the Bitcoin bubble first happened, I said, well, you know, this is the same thing internet did. It came at the late stage of the tech bubble. It went up dramatically in 1 year and then crashed 93 to 95%. So if Bitcoin follows that, it's going to be at 1,000, give or take, within months. But it's basing like gold, and it's not following the bubble model. So there's always exceptions, and those tell you something. I think there's a high chance that Bitcoin could be basing here, and you get one more rally. Now, there's two scenarios here. I think Michael Turpin's going to favor more the second one. My scenario is this ends up, if we do continue this bubble with more tax cuts and more stimulus into next year, that this is the final bubble, and it'll hit 20, 25,000, then it'll crash to 1,000. Still have long-term potential like the internet did for decades. Blockchain is the potential, not the coins. Michael Turpin may argue, I think, from me talking with him, that he thinks cryptos will do the best when we have this crisis I'm talking about. I don't think so, but I do think 25,000 is a possibility. Now, real quickly, since we have two scenarios here, and since this bubble has gone on and on and on and on, and stimulus and on stimulus, the best way is just to hedge yourself at critical points, like now. There is a chance this thing's peaked. Rodney worked out a simple model. You can take a large cap portfolio, buy put options on the S&P, which are a little cheaper, and on the QQQs, the tech stocks, which are a little more expensive. For about 4.5%, you can leverage a portfolio. And why would you want to do this? The thing I preach the most, and which is the hardest for people to get, when a bubble finally burst, and this is 7 out of 7 in the last century, stock bubbles, the first crash is 30 to 50%, 42% on average in the first 2.6 months. People get crucified right off the bat. You can hedge that into March. If this is going to happen, we should see it by January, February. If we don't, you can get out of your options, recoup some of your time premium. Maybe it's only cost you 2 to 3%. This is a way you don't have to sell your stocks, you don't have to pay capital gains taxes, and you can hedge. And if we get into late next year, I'm going to be ringing the next bell. So I'm going to be saying, get out or really hedge. Thanks for being a good audience.